You are doing everything right. You have a job. You are saving money. You are investing. Every month, a portion of your paycheck flows into a retirement account. You picked a fund that sounded responsible. A professional team manages it. It has a long history. Your HR department set it up for you. And right now, quietly, invisibly, without a single alert, you are on track to lose more than $200,000 from it. Not from a crash. Not from bad timing. Not from panic selling when the market dropped. From a number so small that most people never look at it. It is called an expense ratio. And if yours sits above a certain threshold, as millions of American retirement accounts do right now, it is compounding against you. Every year. Every month. Every dollar you add. Until the cost reaches a number that would make your stomach drop if you ever saw it laid out plainly. Here is what is actually happening inside your account. Every fund charges a fee to exist and operate. This fee is called the expense ratio. It is expressed as a percentage of your total assets, and it is deducted automatically, not as a line item, not as a bank transfer you approve, but as a quiet, invisible reduction in the value of your fund each year. If your fund carries an expense ratio of 1%, you pay $1 for every $100 you have invested every single year. That number sounds harmless. 1 cent per dollar. Surely it cannot make a meaningful difference. This is the trap. Because you are not evaluating 1 year. You are evaluating 30. In a single year, 1% on a $10,000 account is $100. Painful, but manageable. But money does not sit still. It compounds. And when you subtract 1% per year from compounding returns, you are not just losing 1%. You are losing the growth on that 1%. And the growth on that growth. Year after year after year. Until the missing amount is not hundreds of dollars. It is hundreds of thousands. This is exactly what John Bogle spent his career trying to tell investors. Bogle founded Vanguard in 1974, built on a single radical premise, that investors would be systematically better served by a fund that simply owned the entire market at near zero cost than by paying active managers to try to beat it. He called it the cost matters hypothesis. The idea is straightforward. The total return of every investor in a market, as a group, must equal the total return of the market, minus the costs of all the transactions and management fees they collectively pay. When you add up all the winners and all the losers across every fund, the market does not have losers by definition. Costs are what creates them. The financial industry called him naive. He kept going. Bogle was right. The SPIVA U.S. scorecard, published by S&P Global twice a year, tracks the performance of actively managed funds, the funds with research teams, analysis departments, and experienced portfolio managers against their benchmark indexes. The data is not kind to the industry. Over any 15-year period in the most recent data, approximately 90% of actively managed large-cap U.S. mutual funds underperformed a simple, passive S&P 500 index fund. 90%. The funds with the highest fees, staffed by highly paid professionals, delivered worse outcomes to the investors who trusted them. Not occasionally. Not in one bad stretch. Consistently, across decades of data. Now take this from a concept to your actual money. You are 30 years old. You invest $500 every month into a retirement account. You plan to retire at 60. That is 30 years of consistent monthly contributions. The S&P 500 has delivered an average annual return of approximately 10% across its history, a number documented from market data going back to the 1920s. For this scenario, use 10% as your baseline gross return before fees. Now look at two paths. In the first scenario, your money sits in an actively managed mutual fund. The expense ratio is 1%, actually below average for this category, where many funds charge 1.2 to 1.5%. After the fee, your effective annual return is 9%. Over 30 years, $500 a month compounding at 9% produces approximately $914,000. That is a genuinely impressive number. By any measure, you have built significant wealth. Now look at the second path. Your money is in a low-cost index fund. A total market fund or an S&P 500 fund carrying an expense ratio of roughly 0.03 to 0.05%. Functionally, this is so close to zero that the difference barely registers. Your effective annual return is essentially 10%. Over 30 years, $500 a month compounding at 10% produces approximately $1,130,000. Write both numbers down side by side. 914,000. 1,130,000. The difference is $216,000. You contributed the same amount every month. You received the same underlying market returns. You took on the same level of risk. The only variable was that single percentage number, the one buried in a fund prospectus that almost no one reads. $216,000. Now for the twist that should permanently change how you think about investing. The fund that cost you more, the one with the analysts, the track record, the professional management team, delivered less money. Not a little less. $200,000 less. Not because the managers were incompetent. Because of a mathematical reality no amount of skill can fully overcome. To justify a 1% annual fee, an active fund does not just need to match the market. It needs to beat the market by more than 1% every year for 30 years. In any individual year, a talented team can do this. Some years they beat the market significantly. But the problem is the word every. Because even a modest shortfall in 1 year, the kind of minor underperformance that looks small in a quarterly report, is a shortfall that compounds. The low-cost fund takes that same dollar and lets it grow. The high-cost fund redirects a portion of it into management fees. Repeat that dynamic for 30 years. The gap does not stay small. It does not stay manageable. It becomes $200,000. Vanguard's own research on cost-adjusted returns has shown consistently that expense ratio is one of the single strongest predictors of long-term fund performance. Not recent returns. Not the manager's historical track record. Not the star rating on a financial comparison site. The variable that predicts long-term performance most reliably is the one most investors never check. William Sharpe, the Nobel Prize-winning economist who developed the Sharpe ratio, the tool used to measure risk-adjusted return, put it simply, after costs, the average actively managed dollar must underperform the average passively managed dollar. This is not a theory. It is arithmetic. It is true before the data is even collected. And yet, as of recent industry surveys, the majority of 401k assets in the United States still sit in funds with expense ratios well above what low-cost index alternatives charge. Not because the people who hold those accounts made a bad decision. Because no one showed them the math. Here is where this comes back to your account, right now. If you have a 401k through your employer, log into the platform today. Navigate to the funds currently holding your money. Find the expense ratio listed for each one. You are looking for anything under 0.2%. Broad market index funds, S&P 500 funds, total stock market funds, typically carry expense ratios between 0.03 and 0.15%. If your current fund shows 1%, 1.2%, or higher, you now know what that number actually costs over a 30-year investment horizon. The fix is not complicated. You do not need to become a market expert. You do not need to predict where stocks are going. You do not need to take on more risk or change how much you invest each month. You need to look at one number. And if a lower-cost alternative exists inside your plan, and in most 401k platforms, it does, you can move your current balance and future contributions there in a few clicks. No market timing. No stock picking. No financial strategy more sophisticated than choosing the cheaper option. This is what Bogle was trying to explain for 50 years. Not that markets are predictable. Not that there is a secret system only the wealthy know. Just that what you keep matters as much as what the market returns. And the portion that quietly leaves your account every year, compounding against you while you sleep, is the portion that ultimately defines the difference between a comfortable retirement and a genuinely wealthy one. The system is not designed to hide this from you deliberately. But it is not designed to make it obvious, either. The fee is small enough to feel irrelevant each month. It never triggers a notification. It never appears as a line item in your banking app. It is a number in a document almost no one opens, quietly redirecting your future wealth somewhere else, year after year, amplified by the same compounding math that is supposed to be working for you. You are still doing everything right. You have a job. You are saving money. You are investing. And somewhere in an account right now, a number you have probably never looked at is deciding whether you retire with $900,000 or $1,100,000. Check the number. Because the difference does not live in your income. It does not live in your risk tolerance or your market timing or how much you know about stocks. It lives in a fraction of a percent, and $200,000 is waiting on the other side of that one decision.